When a corporate giant like Shell reports its earnings, the entire market pays attention. But behind all those headline numbers, there's a really fascinating story of tough choices and a high-stakes balancing act. So today, we're diving into their latest results to answer one critical question. Is Shell actually pulling it off? Are they delivering more value for shareholders while also making good on that promise of less emissions? Let's break it down.
So, what we're looking at here is Shell's fourth quarter 2025 earnings report and the big investor call that went with it. Now, this is where the company's leadership doesn't just give you the numbers, they lay out their entire strategy for how they're going to navigate this rapidly changing energy world. It's really our chance to look under the hood.
All right, here's our game plan. First, we're going to look at the raw numbers, the scorecard for the quarter. Then, we'll get into the story that Shell wants to tell, a story about discipline and performance. After that, we'll dig into the cracks in the portfolio, the stuff that has analysts worried. And finally, we'll look at Shell's map for the road ahead.
Okay, so right out of the gate, the top-line story, well, it wasn't exactly what Wall Street was hoping to see. Let's just get straight to the numbers.
So, the big headline? Shell missed analyst expectations. Earnings per share came in at $1.14, but they were expected to hit $1.21. And revenue fell short too. Now, on the surface, this looks like a pretty straightforward disappointment, but trust me, the real story here is a lot more complex.
Right, so despite that headline miss, Shell's leadership came out swinging with a completely different narrative. They wanted to talk about intense discipline and about delivering on the things they can actually control, no matter what the market is doing. Let's see how they framed their performance. And they came with receipts. Look at this. They've already hit over $5 billion in structural cost reductions. That's a target they weren't even expecting to reach for years. And for investors, they announced another huge $3.5 billion share buyback and bumped up the dividend by 4%. The message they're sending is crystal clear. We can't control oil prices, but we are absolutely laser-focused on efficiency and on returning cash to you, our shareholders.
And here are the words from the CEO, Wael Sawan himself. This quote, it basically sums up their entire message to the market. You can trust us. We are a company that keeps its promises. It's all about building that credibility with investors.
So what about that less emissions piece of the puzzle? Well, they reported some pretty significant progress there too. They've apparently already hit 70% of their 2030 target for their own operational emissions. And they've completely gotten rid of routine flaring in their upstream business. This is the other side of that value coin they're trying to show everyone.
But of course, it wasn't all sunshine and roses. The analysts on the call were sharp, and they very quickly started poking at some serious concerns that were kind of lurking just beneath the surface of the portfolio. And this is where the story gets really interesting.
And here it is, the first major crack that the analysts jumped on. Just look at the chemicals and products line. While integrated gas and upstream are pulling in billions, the chemicals division is actively losing money. It's acting like a real anchor, dragging down the company's overall performance.
And the CEO, to his credit, didn't really mince words. He called it bleeding and made it super clear that their priority isn't to just sit around and wait for the market to get better. Nope. Their plan is to go in and aggressively cut costs to stop the losses. They are in full-on damage control mode here.
Okay, so this all leads to the second, and you could argue much, much bigger concern that really dominated the Q&A part of the call. If the whole strategy is to cut costs and sell off parts of the business, doesn't that just mean Shell is becoming a smaller company?
And wow, this chart makes that concern impossible to ignore. We're looking at reserve life. That's a key metric in the oil and gas world that basically measures how long a company can keep producing at its current rate. And it has dropped a stark 15% from 9 years all the way down to 7.8. Yeah, that is a number that makes investors very, very nervous.
The analysts, they did not hold back. They basically just voiced the market's biggest fear out loud. Here's Alistair Syme from Citi putting the question directly to management. And this isn't some abstract worry. It's a public challenge to the company's entire long-term strategy.
So how did Shell respond to that? Well, they argued that this isn't shrinkage, it's a strategic pivot. They claim they are consciously choosing to sell off their lower-margin assets and then reinvesting that money into much more profitable projects. Their whole argument is that they're focused on value over volume, making every single barrel more profitable, even if it means having fewer barrels in total.
So, with all those challenges laid bare, what is Shell's actual plan for the future? How are they going to navigate these pretty difficult waters?
Their roadmap really boils down to these 4 pillars. 1, they're going to keep a tight grip on spending.
2. They're doubling down on their most profitable areas, like LNG and deepwater oil. 3. Shareholder returns are going to remain a top, almost sacred priority. And 4. They'll only look at buying other companies if it meets a very high bar for creating value.
And to wrap it all up, the CEO ended the call with this message of confidence. The core idea he's selling is that all these tough choices they're making today are actually building a stronger, more resilient Shell for tomorrow, one that's ready to deliver no matter what the market throws at them. Which leaves us with a big, lingering question, doesn't it? Shell is proving it can be disciplined, it can be profitable, and it can focus on shareholders right now. But can a strategy of value over volume really sustain a company of this size in the long run? That right there is the billion-dollar question that the market is going to be watching very, very closely.